We're going to do one more section on how to maximize the value, which is a big part of what this is all about. And then we're going to talk about some case studies that I hope will describe in practical terms all the things we've been talking about, and also have a little bit of fun in seeing how good you are at doing exit valuation. So of course, when you sell a company, you want to get the maximum value. I think from a shareholder point of view, that's actually a fiduciary responsibility of the board and the people that are executing the process. And this is a big area, and this is really a big part of the skill of what this entire industry does, is tries to make sure that the shareholders get a fair value for a company. And I think there are 6 categories of ways you can get the value up. One of them, obviously, is to increase the growth rate. Another one is what I call structural value increases. Number 3 is capitalizing on inefficient markets. Number 4 is illuminating the strategic value. Number 5 is maintaining multiple bidders. And number 6 is sales and negotiating skill. Going through those fairly quickly, this one about increasing the growth rate is actually another industry. There's a whole industry called exit planning or growth consulting. There's no agreement on what they should be called. But there's a small but burgeoning industry that actually helps people increase the value of their business by increasing the growth rate, usually leading up to a transaction. And in my experience, it can be done about half the time. About half the time, there's a way to do something that makes a meaningful difference in the time that you have. And the challenge is that it takes a while to do this. It usually takes several quarters of results to be convincing to the buyers. And I'll talk about an example where we did that. Structural value increases are often called financial engineering. And these are things that can be done usually with the deal structure or the corporate structure that can increase the value by maybe 10 to 25%. These can be things like balance sheet changes, asset versus share sales, financing mechanisms or deal structures, tax innovations, and there's lots of possibilities here. Again, a complicated area, often done in consultation with the M&A advisor, deal lawyer, and the tax advisors. Often the tax advisors, by the way, are not the same as the accounting firm. Sometimes there's a subspecialty there as well. And there's whole firms now that just do tax advisory in the context of transactions, because it's itself a very complicated area where if you want to be the best, it's all you can do because it's such a complicated and rapidly changing area. But lots of possibilities here. Lots of millions left on the table because just something simple in this financial engineering category wasn't thought of. A lot of creativity. A lot of this is proprietary technology. A lot of these structural and tax innovations, once they're discovered, are not widely disseminated. You know, I have had to sign non-disclosure agreements with people who worked on transactions where they said, okay, we're going to do this. We need everybody to agree. You'll never talk about what we did here. Because they spent a lot, it's a discovery, an innovation of theirs. They want to keep it quiet as long as possible. But there really is a difference between the really creative people in this field and the average people. Capitalizing on inefficient markets is one that really fascinates me. And it's really an area that's most interesting for transactions under $100 million. And what it recognizes is that the market for selling a business, especially these smaller businesses, is very inefficient. And economists talk a lot about the efficiency of a market. And they have whole books on this. But there's a couple of characteristics of an inefficient market that are important for what we're talking about here. One of them is that information is difficult to access and there's no transparency, which means you can't see what's going on in this market. And there are a small number of buyers, and there's very few products for sale. And if you think about it, these are kind of the exact opposite of the real estate market. The real estate market is extremely transparent. You can log on and see the price of your neighbor's home the last 3 times that it's sold now. And there's lots of buyers for a house. And there are lots of houses that are pretty similar for sale. So that's a very efficient market. And what that means is that the buyers that come through are going to offer a pretty similar price. And it means for a certain dollar value, the houses you're going to get are also pretty similar because the market is efficient. An even more efficient market is the New York Stock Exchange. You know, the number of buyers and the number of sellers for a share of Apple, each is enormous. And that's why when you see the shares selling, they're all selling at pretty much the same price, plus or minus a fraction of a dollar, because it's an efficient market with lots of transparency. You can see who just bought the last 10 shares and who sold the last 10 shares, at least the firms that did that. So what this means, though, is a very big advantage for the seller. What's fascinating to me about this is that this lack of efficiency is asymmetric in the transaction, in that the advantage of this lack of efficiency is all to the benefit of the seller. And I'm not sure if that made any sense, but what it means is that the characteristics of this inefficient market can be taken advantage of to get more money for the seller, but they can't be as easily taken advantage of by the buyer today. And it's because of the imbalance in the number of buyers and sellers. So it's pretty interesting because there are things you can do to take advantage of this asymmetry to get more money. An example was the Vineyard transaction. You know, Procera wanted to buy Vineyard. They weren't really sure what Vineyard was worth because they didn't have any data. They had no transparency. They couldn't look at the last 10 deep packet inspection companies that were sold. Even if they could figure out which they were, they couldn't benchmark them because there was no financial information available. And we also knew that there wasn't a lot for sale. There was like one. We looked. We thought, well, who else could they buy if they didn't buy us? And we didn't have an obvious choice. So that inefficiency gave us the courage to ask for like almost double the price. And because they weren't really sure, they said yes. In an efficient market, I mean, can you imagine trying to sell your share of Apple for twice as much as the last guy who sold a share of Apple? So these inefficiencies are really interesting from a market structure point of view. But from a practical point of view, it means today sellers can have an advantage over buyers that could be worth 25%, maybe 50%, just because of the market being inefficient. It's fascinating, to me at least, anomaly. Illuminating strategic value is something everybody thinks about. This is not any kind of a esoteric or mysterious thing, but it's often the largest fundamental increase in the selling price. So what I talked about a minute ago was not a fundamental. Fundamental means it relates to the fundamentals of the business. This strategic value is real. And I don't think that in the context of a transaction you can create strategic value. It has to either be there or not before you get started, because strategic value takes a long time. You might be able to grow a company quicker in a few quarters, but you can't create strategic value. But it's often not clear that it's there. So I think the best word for it is to illuminate it. It's there. The challenge is to find it, to shine a bright light on it so that the buyers can see it, understand it, and therefore bid higher. This is often the most valuable contribution of the M&A advisor. And a lot of times the buyers are unwilling or unable to see that. A lot of times, because the smaller companies, the targets are usually the innovators. They very often 30-ish kids, have the idea of why this is strategic. And they have to convince some 50, 60-ish executives why it's strategic. And that can be challenging. You know, a friend of mine at Google told the story publicly. I'm not telling any stories out of school here. Told the story about how the 12-person team that developed the Android operating system came to Google and convinced them there was strategic value. Google wasn't looking to buy an operating system. And these 12 youngsters, with one very good M&A advisor, managed to get the idea across that for Google, owning Android was strategic. And of course, now we all know what a big transaction that was, but that wasn't Google's idea. That had to be kind of rammed down their throat, as my friend there in corporate development described it. Multiple bidders is also something that's kind of obvious, but surprisingly often not done, and often not done well. And I think that if you ever see a situation where one of your companies is sold to an unsolicited single offer situation, it's almost always a lost opportunity. I'm not going to say always. I'm not going to say 100% of the time you could have got more, but generally, I think that business should have multiple buyers to, of course, maximize the price, but more importantly, to increase the probability that it actually gets done. That's, in my opinion, far more important. Also, the buyers, given the choice, will move slowly. If the buyers believe that they are in a situation where there's no other buyers, it's to their advantage to go slowly. They'll learn more about the business. They'll be able to negotiate longer. But once they understand that they're in a competitive situation, they might not like it, but they will certainly move a lot faster when they know that somebody else might just beat them because they were more nimble. In my opinion, it's also essential to demonstrate good governance. If you're a director, I don't know how you can look another shareholder in the eye and say, we got a good price, because in this inefficient market, even the experts don't know what the right price is. And so if you've got 3 offers, one of them is 22 million and one of them is 20 and a half and one of them is 19, you can feel pretty good about taking either of those top 2 offers because you had enough data to feel reasonably comfortable that that was the price. And more importantly, you can show that you did the right thing. There's also just plain selling and negotiating skill. And there's just no question in my mind that some salespeople are better, often much better. In the company that I started, I had at one point 30, 35 people selling exactly the same thing, no territories. There was 1 or 2 people who would sell 3 times as much as everybody else. And I made a point of paying them 3 times as much. But they were just better. They were gifted salespeople. And selling a company is just like selling anything else, only bigger and more complex. The difference is when you've only got one for sale, the sales skill translates into not selling more because there's only one. It translates into a better price. That's where that skill manifests itself. And I believe that a good M&A advisor can often get 50% more for a company. And everybody says, really? Can you really get 50% more? At first you'd think, it's not intuitive because we're all used to efficient markets. We're all used to a house where a fabulous result is 5% more. Or we're used to, you buy a share of Apple and it dipped by 0.2 of a dollar that week because of some bad news. You got a better deal. We're not used to things that are that inefficient. But I've seen it happen many times. And I've even helped make it happen quite a few times. And I'm going to talk about a couple of case studies in a minute where I can actually tell you exactly how it happened. And this is something that most shareholders don't believe. I think if more people understood this, then we'd have more exits that were designed and executed. Because if people really appreciated that there was a 50% difference, probably plus or minus 50% around the price, depending on the quality of the work that was done, I think we'd see more done well. The part that vexes me is that 80 to 90% of the time, the people that are involved in these sign an NDA, which means we can't use them for a learning experience. We can't talk about them with the price. We talk about these generalities, which I find very unsatisfying compared to an actual company with an actual story with real dollars, ideally with a video of the people who actually did it so we can all see that. And I've got quite a few resources on this. Again, a big topic. I went through that fairly quickly. Any quick questions on any of these opportunities to get a higher price?
So where do you go when you're researching comps for these things? Comparable values to use in negotiation? PitchBook and all those guys?
It's really hard because very few of the transactions get reported. And we've talked about this in the context of ARI, where we're we work really hard just to get 2 or 3 case studies we can use in training sessions like this. I mean, it's almost impossible. And there's the best data out there of all is coming out of Willamette University. It's some new research that Rob Wiltbank's team has done. What they did is they combed through all of the 8K reports from the public companies in the US. And because these companies were public, they had to disclose. And Vineyard, by the way, is a single example of that. The company that acquired Vineyard was public, and Vineyard was just barely big enough to be material. So they had to disclose everything. More importantly, they didn't mind us telling the whole story because they'd already disclosed the parts they were nervous about. So what Rob Wiltbank's team has done, through some what I would think of as abuse of grad students, who they made go through all the 8K reports, taking the data out of PDFs, but they've got a fabulous data set. But unfortunately, it's only a data set of companies that were acquired by public companies, which is a small percentage. Wade and I were just talking, it might be 15% of all of the transactions, maybe only 10%. So it's a limited data set, and it's a skewed data set because most of the transactions aren't with public companies. But it's really hard to find the data.
As a quick question, on the component of the value that the M&A advisor really can contribute to, are you seeing, particularly for those on the higher end of your scale, them building into the fee arrangement, that sort of incentive and alignment to kind of move some of the fees toward the upper end of the value chain for an exit? It's
a great question. And the short answer is no. I'm not seeing very many M&A advisors build in a success fee that has a nonlinear measure. And the reason that I think it doesn't happen is it creates a disalignment or a misalignment. It means that the M&A advisor might want a transaction that's not the same as the shareholders might want. And you might think, well, no, everybody wants to get the price up. But there are other considerations. Fit, for example. A lot of times companies will accept a less high valued offer because it's what the team wants and the shareholders are willing to accept a little bit less money to see the right thing happen to the company. So I believe that the right balance between all of the factors is a straight linear relationship. So if the M&A advisor gets 50% more, their success fee is 50% more. And I think when you start to get too creative, there's not enough knowledge yet to understand what that curve should really look like. And there's often an inflection point in that curve. And the problem is figuring out where that inflection begins. It's not usually just a simple geometric curve. It's like, okay, it's this much to here, and then it goes up. That point is, again, where the M&A advisor has an asymmetrical knowledge about what's fair. And an unscrupulous M&A advisor might set that point low to guarantee or increase the chances that they're in that steeper part of the curve. So for a whole range of reasons, it isn't done very often, and I don't think it's a good practice, even though philosophically I agree with your point.